Our goal for this show today is to kind of do a compare and contrast between two tax accounting systems, the US and the UK, arguably the two most important tax accounting systems in the world. And we're going to talk about it from a crypto investor's point of view. Now, before we go into it, I just want to say, part of our goal is to make it clear that every tax system is different. And if you decide to relocate, you really want to take time and think about where you're going, what tax entanglements you might have, and to really think about that before you make the move. A lot of people talk to me about relocating to other countries. And they think that there's a magic person out there who seems to know all US tax and all the tax laws in that target country. And that is a real fallacy. Everybody's tax regime is really different. Everybody thinks their own tax regime is oppressive. But until you realize the taxation around the world is not as pretty as it might seem. So you really need to stop and think, especially as a crypto investor, especially as you might be somebody who might be effectively relocating assets into a more aggressive tax regime. Think hard. Just real quickly, I did some advanced research, and I'll say this for anyone. If you're looking to learn about the tax rules in another country, Ernst & Young offers a worldwide tax guide. So put this in your browser, search window, EY worldwide guide, and you'll find personal tax rules and laws in there. And they basically offer a real quick summary of almost 200 countries and laying out the rules. It's a great summary. It's a great starting place for your adventure. Welcome to the Clinton Donnelly Show. Today we have with us Jamie Nuttall from Myna, and he's one of our, he's been on our show a couple different times. You want to say hi real quickly, Jamie?
Yeah, sure thing. Thank you for having me, Clinton. It's good to see you again. So my name is Jamie Nuttall. I am the head of crypto tax at Myna. Myna Accountants, that's mynaccountants.co for the website in case you want to reach us. We are one of, if not the leading crypto accountancy firm in the UK. Part of the reason for that is we are self-proclaimed degens. So myself, for example, the managing director and another one of our non-execs are all part of the Bored Ape Yacht Club ecosystem. Amongst many other crypto and NFTs, I'm sure we could go on forever about that. We're also all part of some kind of body. For example, I'm part of the ACCA, so I'm a fellow member of the ACCA as well. So I'm chartered and certified as an accountant.
Thank you very much for the introduction, Jamie. Now, I did take the liberty, Jamie, to look up the tax rates, just the ordinary tax rates. And you have three different tax rates in UK. The tax rates are 20%, 40%, and 45%. So basically, the 20% rate kicks in, which in US dollars would be about 47,000 US dollars. You're going to be paying 20% tax rate up to there. On top of, if you're above that, up to $156,000, you're at the 40% tax bracket, and above that, it's a 45% tax bracket. On one hand, I like the simplicity that there's only three levels, because in the US, they keep adding them and taking them away. I think there's about five, and there's also a zero tax bracket, which is kind of like, basically they give you money back. So it's complicated, and we layer all sorts of extra taxes on there. But I do like the simplicity. But it's, you're jumping from 20 to 40%. People on that edge might feel that pain. Do most people that you deal with, do they fall into the 40% bracket or one of the other two brackets?
Yeah, it's a good question. And just before we start on that, we do actually have a tax-free amount as well, by the way, 12,500-ish to start off with, and then we start those brackets as well. So it's a little bit more similar, but still we don't quite have any more than those sort of three layers after that. In terms of the clients that we deal with, we do have people in all sorts of brackets. Because we deal with everyone from simplistic retail investors all the way through to large organizations and large decentralized exchanges, to be honest with you. We do see an absolute array. And I would say the average person that I deal with is probably in that 40% bracket range. So that's someone who earns over £50,000 a year in total income, including their capital gains and crypto.
When you sell a cryptocurrency, you experience what typically is called capital gains. It's a fairly universal term, but how it's taxed there's a lot of differences in each country. Can you briefly summarize how the sale of a cryptocurrency is taxed in the UK?
Yeah, so in most situations, it would be under that capital gains tax regime, which you mentioned. And that in itself runs alongside the income tax regime of the 20, 40, and 45% rates. With capital gains in the UK, it is 10% and 20% unless it is residential property, and then it's 18% and 28%. So ignore that for now because we're not talking about property. But with crypto, it'll be 10% or 20%, and it has its own tax-free amount called the annual exemption, which was 12,300, and then it was 6,000 last year, and it's currently only £3,000. So what we have to do is take the complete picture of an individual, all of their income, including PAYE, maybe they've got self-employment, businesses, etc. We then kind of stack them on top of each other, and then that will give us what rate each section of the account of the income would be in. So with crypto, usually it would be under the capital gains tax regime and be at either 10% or 20% after the tax-free amount of the annual exemption.
So the capital gains tax rates are 10% and 20%. Does it matter how long you've held those?
No, no. Contrary to popular belief, it doesn't matter how long you hold them from a capital gains perspective. However, the frequency of transactions, amongst a few other criteria, can influence you moving from one regime, capital gains tax, into the income tax regime if it is considered a trade rather than a general investment.
Okay. Now, the 10, if I understand it right, the 10% capital gains bracket is for people that are in the lower 20% income tax rate. Is that right?
Correct. Yeah. So we have the basic rate band, the higher rate band, and then the additional rate band. So that'll be 20, 40, and 45. And then in capital gains would be 10 and 20. So the basic rate band would be 10% capital gains, 20% income tax. The higher rate would be 40% income tax and 20% capital gains. And an additional would be 45% income tax, but it just continues as 20% in the capital gains tax regime.
Now, do you have an additional tax based on the province of the United Kingdom that you're in?
No. So I know in the US you have sort of
State
um,
taxes. Yep.
state taxes that are kind of unique to each state. We don't have that in the UK. Scottish tax rates are slightly different, so it's a similar mechanism, I guess, but everywhere else is the same.
The US, a 40% tax rate is really high. But then, of course, I mean, we don't have a 40%. Our highest one right now is, I think, this year, it's 37%. But you would get a state, depending on what state you lived in. If you lived in California, there's an additional 13% tax on your capital gains. So it can be stiff. You go to other states, they don't tax income at all. So it's very different. Hey, now, one of the things that a lot of people get income from is staking. So I would differentiate staking from airdrops. In the US, these are both types of cryptocurrencies that you're receiving for not really doing a whole lot. I will might be doing something, but not a whole lot. They're kind of coming to you. How are staking rewards taxed in the UK?
So that's a very good question. So when we talked about how crypto is taxed initially, I said most of it's under the capital gains tax regime. Now, staking is one of those exceptions where actually it's under the income tax regime. If you, as you and I know, staking is not interest, but it's very similar in its mechanisms. And for those that aren't too savvy from a crypto or a tax perspective, I would think of it like interest, although it's treated slightly differently for tax purposes. And what that means is it's going to be taxed under that 20%, 40%, or 45% bracket as miscellaneous income, though there's no national insurance attached to that. And we'll put national insurance as a pin on it for now. But you do get a trading allowance in the UK. So what that means is for the first £1,000 of any trade that you have, miscellaneous income, self-employment income, you can have that as tax-free instead of your expenses. So for the layperson, if you have staking income up to £1,000, it could be tax-free within the UK. But yes, it is under the income tax regime rather than the capital.
That's great. And I think in the US, we call it, it's considered like you call it miscellaneous income. It's basically the same thing we call it. It gets lumped right in. We too would not, because that's income, we would then look at, is it subject to self-employment tax? Self-employment tax is same thing as Social Security tax, which is not, it's not really the same as national health insurance, because each person has to handle that their own health insurance, but it's part of that old age pension, the amount you kick in, Medicare pension program for when you get really old, health when you get insurance, you get old. Basically it's an extra cut the government takes, which can add up to about 12, 13% for the individual, maybe a little bit higher if you're self-employed, on top of the income. Now in UK, you use it really quickly, and our US listeners wouldn't hear it. You use the word PAYE income, or payee income as it's sometimes called, which is pay as you go. Is that correct? Pay as you earn?
Pay as you earn,
Pay
yeah,
as you
same
earn.
thing. Sorry, I'm so used to saying it just off the cuff.
It's like, oh wow, it's a fun phrase. In the U.S., that's basically equivalent to just getting a W-2 income and having withholding. So the pay as you earn is basically your employer is withholding it as you earn. Same concept. But the government, I think in UK, takes a little more ownership of tracking that for you.
Well, yeah, we do. So, from my understanding, and correct me if I'm wrong here, Clinton, all or most US citizens will need to do a tax return, whereas in the UK, most do not.
How do you not do a tax return?
It's through this pay-as-you-earn mechanism where everything is taxed at source, and we have account departments or business owners, if it's a small business, calculating using software how much should be deducted and how much shouldn't be. And it's normally right. And if it's not, HMRC kind of correct it, which is a lovely mechanism. And a big contrast to the fundamental tax differences between both countries.
Now, so the government at the end of the tax year sends a statement to individuals saying this is what we know you owe, and you basically sign it and go. Is that what's involved?
Not even that necessarily. We pay as we go. So every month you pay your taxes at source. So the employer would be responsible for taxing it and sending it to HMRC, while the employee would then receive the net amount. And then the end of the tax year, which for some reason is the 5th of April, by the way, we would get what is known as a P60 or a P45 if you've quit. So P60 is when you're continuing service throughout the year. And it would kind of summarize how much you earned, how much you were taxed, how much national insurance you paid, maybe even student loan. And if it's wrong, you can either call up HMRC and help them sort it out very quickly, or in some cases, they would actually send you a letter saying, this is not quite right, you owe more, so you owe the difference, or there's a refund, here's a check. So it's all sorted for you. You don't even really need to call them in most situations. The only time you really need an accountant per se is if you've got other income like self-employed income, rental, crypto, anything that isn't taxed at source effectively.
We know 2 times the IRS has put forward proposals to do that very thing. But I think I would not be surprised within 10 years we're in that position in the US where fundamentally we're giving money. Right now, we use tax law to basically provide welfare to people. So do you have lots of kids? Well, we'll give you credits against your taxes you don't make that much money? We'll give you some money. You have you're going to school. Oh, here, we'll give you some money. So it's become a big way to give money back to people who are actually earning it. But then they have these things, they call it refundable credits. So even if you're earning nothing, you'd still get money. All right. So it's an indirect way of doing welfare, and it's rife with fraud. It's just a massive problem. Let's talk about airdrops. Now, this is really big this year. People are getting airdrops left and right. If you have money in a particular coin on a blockchain, the amount you have on a certain date, they're going to give you, match that number with a new coin. And people do this sort of thing. So they're trying to really harvest and make a lot of money off these airdrops, pump and dumps as they might be. In the US, the position of the US government is that that is treated as ordinary income. Airdrops are treated as ordinary income at the fair market value in US dollars on the date you received it. And ordinary income is our phrase for taxing, like the basic income tax regime that you call it over there in UK. So it's ordinary income tax that are all our tax brackets, as opposed to capital gains. Then, if you receive a coin, let's say it has a value of, let's say you receive $10 worth, you have to pay income tax on that $10. You then later sell it, you're going to experience either a gain or a loss, but this is now a capital gain or a capital loss. So if 2 years later you sell it for $15, well, then that $5 gain is now that is taxed at capital gains rates, which in the US, since it's over a year, is a long-term capital gains rate, which is 15% for most people, some 20, the wealthier 20. So if it's short-term capital gains, short-term capital gains in the US are taxed as ordinary income. So it's a bit higher rate. So I think a lot of people get frustrated at that because a lot of times the airdrop comes, and it's alleged to be worth something, and within months it's worth nothing, and people feel offended that they have to pay tax on that airdrop at the value at which it was received. And so that's a lot of people irk at that. But in our tax code, the way we look at that is it falls under Section 61, what the definition of gross income. It's called a treasure trove. If you find, you're digging in the backyard and you find a bar of gold, well, you're subject to tax upon the day you found it. So, love it or leave it, it's been that way. And so an airdrop, in our legal sense, looks a lot like, you found some gold and you're taxed upon it. Of course, the ordinary income's taxed at the regular brackets, and you have to track it. Now, some people say those are dummy coins. They were never worth that amount. And that creates a little bit of a hassle for us at the end of the year to say, are these really legitimate? Like the elect Trump airdrop, is that really worth $10? We can, I haven't seen that tested in the law. If we actually want to laugh at some of these coins, just disregard them altogether because it's not anchored in reality. Haven't seen that tested, but I'm sure it will be in the future. So how's it done over in UK?
Yeah, so it's really interesting to hear from you because I know a little bit about how you guys do it from previous conversations with you, Clinton. And surprisingly, it can be similar. It can be similar, but there's effectively 3 options from an airdrop if you're a UK tax resident, and one of the options is exactly as you've described it. It's income tax upon receipt at market value, and then capital gains tax on the gain or loss. So you get a capital loss when you dispose of it. Now, I don't know about you, and this is perhaps more for my benefit than the listeners, but I don't know about you, but with that situation, we can't take capital losses and set them off against the income that you receive from the airdrop initially. So what you can end up having is a situation where you receive that $10, you have to pay, let's say, God forbid, you're in a 45% tax bracket here, £4.50 or $4.50 on that airdrop, and then it's only worth $1 and you've got a $9 loss. So even if you liquidate the asset, you still don't have enough to pay the initial tax burden because the losses can't be offset against the income. Now, I don't know how it works in the US, but in the UK, I personally believe that is a huge hole and flaw for what we see happened a lot. And it kind of forces people to liquidate some of the assets upon receipt in order to afford the tax burden. But what if the receipt can't be broken down to further denominations? For example, it's 1 runestone, for example. You can't break that down. So you're kind of forced to sell it if you have to afford the tax burden. So that's just one stream. Now there's two more potential avenues here. And this is because with the meme coins and with all the degenerate activity on the blockchain, which I absolutely adore, by the way, I'm a self-proclaimed degen. There's also a lot of these scam tokens, which is just absolute rubbish. And if you click on those, there's a good chance you're going to be drained from your wallet, or something negative will happen. Perhaps there's some form of malicious software. So the reason why we have three streams is partly to mitigate that type of thing. Because if someone were to airdrop random tokens, or a token they've created with no value, to people, and they've accidentally started trading it for value, it can create a false value. And this is, it's not going to be good if there's a false value and you're going to get taxed on it. So one of the other three streams is, if you did not do anything to actually receive said airdrop. So if it just appeared, it is not taxable, no matter what. And a big thing with this, from my perspective, is the likes of ApeCoin. So the Bored Ape Yacht Club members received an airdrop for ApeCoin. No one had to do anything for it. No one even realized it happened. So therefore, according to this guidance, it is tax-free, although the intrinsic value here is astronomical, some of which are, or most of it, were in six-digit figures, but it's not taxable according to that. So then we go, okay, so if you did expect it and you did do something, and it has to be significant, it can't be, I use the exchange. I'll give you a reason why in a minute. But if you completed surveys, followed people, and completed tasks, essentially, then we do exactly what we said initially, and exactly what you do in the US: market value upon receipt, and then the capital gain or loss upon disposal. If you haven't, then the market value is the same market value, so $10 in that example, we just don't tax it. And then there's a gain or a loss upon disposal. Those two are the most common ways of taxing airdrops. The third way, Clinton, and yes, this is where it starts to get complicated, is where we look at it and go, is it an airdrop? Now, you're probably thinking, well, Jamie, if it's not an airdrop, why are you talking about it? Because a lot of people can misidentify certain things as an airdrop when it's not. For example, do you have grocery stores in the US where every time you use the store, you have like some form of scanning ID card, club card type thing, and they give you cashback rewards and points? So that in the UK is not taxable. Okay, the cashback ideology is not taxable. So I can go to shops, do my shopping, I get cashback, I use it to purchase other goods. It is not taxable. So the argument here is, and the confusion is, those airdrops that you're receiving, are they actually cashbacks? For example, if I were to use a particular exchange, a particular market, let's call it Magic Eden, for example, or perhaps it's Solana, whatever it might be, Tensor, and I use it because I want to use it, and I'm trading on it like I would whether I get an airdrop or not. And then all of a sudden they go, "Oh, thank you for using our platform. Here are a load of tokens that have a value now because everyone has it and everyone's trading it." Now, to me, that doesn't sound like an airdrop, although you might look at it and go, "Oh, that's an airdrop. You got given it, it's dropped to you for doing something, or perhaps you didn't know and it just appeared." However, I would argue, say, look, that sounds more like a cashback reward, which is not taxable at all. So we go back to the second option we spoke about earlier, and it's the same mechanism. So there's three ways of going about it, but two of them actually have the same outcome and the same process. So I would, anyone in the UK, please double check initially, is it an airdrop or not? Okay, it's not. Does it sound like a cashback? Not taxable upon receipt. Okay. Another example, is it an airdrop? Yes, it is. Okay. Did you do anything significant to receive it? Yes. Then we carry on with the taxable sort of stream. If you didn't and you can prove it, then it is not taxable upon receipt. And that actually happens a lot more than you think.
I think that is a wonderful discussion to highlight for anyone who's watching, that tax laws are not necessarily simpler outside the United States. Everybody thinks U.S. tax code is crazy. I'm sure they think the same thing about UK taxes in simpler
They're both
elsewhere.
crazy.
It's not. It can get more convoluted. Uh, that is great. Hey, now we were talking about capital gains before, and of course, capital gains is usually considered a tax on gains that are realized. That you actually sold it, you actually experienced some income, some benefit from the sale, whether it's a loss or not, or whether it's in fiat or some other currency. But just recently, the Biden administration has put forward a new budget plan for the next year. Of course, who knows if he'll be elected? But his proposal includes a proposal for taxing unrealized gains, and it applies to anybody who has a total net worth in excess of $1 million. Is there now taxing unrealized gains is, in my opinion, basically stealing from the future, and it creates a massive administrative nightmare because, okay, we got to assess the value this year of that asset and pay a tax on it, a 25% tax. It's not trivial. And then the year following, the fair market value of that asset's gone down, so maybe I have to do an unrealized loss, and I have to reconcile that against prior years. You can see how this gets ugly fast.
Yeah.
Is there a taxation at all on unrealized gains in the UK?
Not for now. As far as I'm aware, and I don't think there are any plans currently, though it wouldn't surprise me if that they start to bring this in specifically to target those crypto investors. There is something similar under the income tax regime where if you do have, say, self-employment, anything that isn't taxed at source, if you meet certain criteria, for example, if your tax bill is over £1,000 and you have less than 80% of the total tax due is paid at source. So really weird criteria. But if you're in that sort of bracket, you actually have to pay in advance as well for the following year's taxes. So it's kind of similar, like a future tax, but it's kind of on the income tax regime, but not on the capital gains tax. It's only upon realization.
Wow, that's incredible. How about a wealth tax? Is there a tax on your net wealth?
So the way our tax system is set up, the more you earn, the more you pay taxes. So that kind of acts in the same way.
Very good. This is a big proposal in the U.S. Our Senator Elizabeth Warren, who's one of the top Democrats in the Senate, has put forward an ultra millionaires tax. So it's like a 2% tax on people with net worth over 50 million US dollars, which is, admittedly, we're talking about taxing like the top 0.5% of income earners in the U.S. Although we're talking about politicians here. This is basically a information gathering exercise, because how do you know what people's net wealth is? You have to report it. So we're going to be adding another. Now this is just proposed; it's not law, but it would basically all your net value of your bank accounts would all have to be reported to the tax authorities, the IRS. So every asset is going to have to be reported. So they will find out a picture, not so much about the 1%, which they'll have a hard time getting because they got lawyers that could tie them up in court, but it's the other 99.5% that are now all of a sudden exposed to this tax. It's a 0% tax if you're under 50 million. In proposal, of course, that could change in subsequent years. But if you fail to report accurately all your wealth, then you start to get into penalties, which go from like 20 to 40 to 50% penalties on the underreporting. So it's a hidden tax on the average person, but guised as an ultra millionaire tax. So every law is different, eh?
Just to jump in there, Clinton, we actually had a warning shot fired from HMRC about 5 or 6 months ago, whereby there's going to be additional penalties, which can be up to 100% of your liability if you don't come forward and you are deemed as to have concealed your earnings through crypto from HMRC. So they've sent warning shots saying, look, come forward. We won't charge you now if you go, if you follow our step-by-step guide, if you come forward and get everything up to date. But if you don't, they're going to do exactly that, Clinton. And penalties, interest, plus additional penalties for depending on whether you came forward or not, whether they prompted you, whether it's concealed, whether it's deliberate, whether it's careless. I strongly believe we've got about 9 more months, maybe a year max, before HMRC, the UK Revenue and Customs, the government, if you like, really come down hard on UK citizens for those who are not declaring crypto. Do you find something similar in the US where a lot of people aren't declaring because they think they can get away with it per se?
Well, that's a great question. It's a very hot topic for me. We know statistically that about 75% of all crypto owners are not reporting their crypto income on their tax return. Now, granted, a lot of these people are small, all right? So if we just kind of reduce that down in terms of population, we have a pretty good sense that about 8 million active traders in the US that have like a serious amount of annual income, whether the high frequency or just high volume or high dollar traders. So we're talking about a lot of people. The IRS has received massive influx of money over the last couple of years, and they are completely rehauling their systems, and they're using artificial intelligence. What was really most revealing to me was in the recent indictment of Roger Ver. They discuss in the indictment how they identified this, and they used something that they called cluster analysis. I'd call it portfolio reconstruction. So they were able to identify some of his blockchain addresses, or Bitcoin addresses, and then by analyzing the blockchain, they could identify all the other addresses that he interacted with going back in time. All right. And they were able, through an artificial intelligence, to determine, was this address one of his own addresses, or was he receiving something from somebody else? So was it income? Was it a disposal? Or was it just an inner wallet transfer? So using this analysis, they could go back to 2014 and reconstruct that he had control over approximately 200,000 Bitcoin. Now, he renounced in 2014. In US, when you renounce your citizenship and you have over 2 million in assets, you basically have to do a pretend sale on all your assets and pay the capital gains on their current value at that date. And once you've paid it, then it's sayonara, you can leave the US. Well, he didn't report any Bitcoin for himself. And so now they've come back and they've reconstructed it. But with this exact same tool, they were able to identify movements in 2017 and 2018 from a couple companies he owned, which were now classified as corporations. And that distribution to a non-US person is considered a dividend. And it was basically, they transferred Bitcoin to him. And so we consider that a dividend because it came from a corporation, and it's, even if it's a foreign person, they are still subject to a dividend tax. So he didn't report that in 17 and 18. So they're looking for $48 million from him. Now, but this same tool, I mean, they know. Now, in the US, they're already gathering, they have all the KYC and transaction data for all US citizens and US taxpayers from US exchanges, Coinbase, Kraken, etc. They just indicted and won a case against Binance. So anyone, in my opinion, anyone who had a Binance account, Binance International, the US IRS has your number, has your information, even though you were maybe pretending you weren't a US citizen, even though you were maybe using a non-US VPN, they know, they got your number. And with this reconstruction tool, all they need to have is really just your Coinbase account or your Kraken account, and they can start to reconstruct your movements. They have all the time in the world. I mean, they just recently indicted a couple in Connecticut who failed to report $2 million on their income back in 2006. That was 18 years ago. And in the US, if you fail to report a substantial amount of your income on your tax return, then it's considered a fraudulent tax return. And there's no statute of limitations protection, which is a limit on how many years the IRS has to audit you. So most crypto traders, going back to 2017, they're all exposed, they're all naked. They think that, that no one's come after them yet, that they're safe. No. They just indicted a guy named Paco in Texas. Very simple. He didn't report 2 million worth of crypto sales in 2017. It were his coins. He sold them. All right. There's no additional crime. There was no narcotics. There was no theft. It's just a simple non-reporting. They did a criminal indictment on him. So a criminal indictment means you're going to pay $250,000 fine. You're going to go to prison for several years. It might be shortened, but you're going to be a felon the rest of your life. So it's not something you want. So this is really the new trend in the US. And the IRS has all the time in the world to crack down. So I think, but I will say that they're being very sensitive to the political ramifications of such a crackdown. And they have sent out letters, they call them CP59 letter, to people who were high income earners who didn't file a tax return at all. And they're saying, we know that you had high income We know you didn't file your tax return, and we want to let you know that you're on our radar, and you need to get current pretty soon. Otherwise, we'll start coming after you. So I think that's a very charitable attitude for a tax service, rather than just simply coming down with a hammer. But I do think I wouldn't say the crackdown with us is within 9 months. I think it's starting to happen. I would think by the end of this year, we're going to start to see more of this portfolio reconstruction technique being used. And I think it'll be used by multiple countries too, because whoever that software company is going to sell it to everybody. So, and it won't be just Bitcoin; they'll be expanding to all the other coins. I think it's certainly a challenge when you're using smart contracts to figure out what it is. But all we have to do in the U.S. is prove that you had what we call positive income. They don't have to prove you made any money. That's your problem. But we know you sold it for a certain amount, and therefore you need to report some income on this line. So I think we're on the cusp of a substantial multi-year crackdown on people. And in my opinion, take advantage of the bull market. Coins are going up to get clean for the past. You don't want this to happen. You don't want to be like the one couple that 18 years later, their lives are just destroyed by the IRS coming in and just crushing them with massive tax bills and seizing their assets. I mean, you were planning on your kids going to college or retirement, and now you're destroyed by a bad decision decades prior. So
it's important to remember, and Clinton and I will understand this because we were within the space. So for anyone who's listening who's in the crypto space, the whole purpose, well, a large proportion of it anyway, is that the crypto space is an immutable ledger. It's there. It's public. It's for everyone to see. It will always be there. Supposedly Bitcoin has never been hacked, but say it doesn't ever be hacked and it's always there. We already have the technology to trawl through forensically to figure out who's got what. And I know this firsthand because that is exactly what my team does for our clients. We look through the blockchain, we tell them, oh, you've missed this wallet. Oh, yep, sorry. We add it, we make sure we have their backs and correctly report it. So we already can do that. So it's not a matter of if the government and HMRC and everyone else can do this, it's when. And it's just a case of advancing AI and technology to the point where they can, at a flick of a switch, just go, Coinbase says you've KYC'd this wallet, that's your name. I can also see that like a sort of a web of other wallets and addresses which you've interacted with, and they can quite easily ascertain which is most likely yours, and therefore create this picture of actually you've probably got something to pay. Deal with it yourself or we will assess you. Now, it's not breaking news, but it's not public knowledge per se, and it's more of a opinion, I guess, than anything else. I don't believe HMRC currently have the correct facility and technology to determine the tax that you could pay, even if they had the wallets. But as Clinton said, it's a matter of time before they will do, and this is internationally. The US and the UK will probably be ahead of it all. And that is when they will crack down. They've given warning shots. They've given us opportunity. And if you're still not doing it, exactly what Clinton said here, there's no statute of limitation. You're going to be in serious trouble. And the worst thing that can happen from a tax perspective in the UK is something called when they open up discovery. So what this means is they can go back up to 20 years. And I don't think Bitcoin was around 20 years ago. So they can go back 20 years and check in on everything that you did from a tax perspective. I don't care who you are. I don't care how squeaky clean you believe you are. They will find something because no one is perfect.
that is really interesting. And one of my reflections lately as I've thought about the implications of this portfolio reconstruction tool. I mean, they go back to any year and reconstruct your digital asset portfolio. But as we start to move into a CBDC world where we're really not using cash anymore, everything is on a crypto, let's call it a government blockchain. Now they can actually see every transaction that you make. You bought that pizza, you're paying for Netflix, you gave money to this guy down the street, it's all there. You can't erase it. It doesn't fade like a fingerprint. So we're entering a time that has never really existed before, where we're living much more in a panopticon, where we're scrutinized about everything we do, and we have to really start to reflect that if I want to do this little transaction and that shows up on my blockchain, will that affect whether or not the bank gives me a loan, whether or not the tax authorities want to do a 20-year discovery on me. We really are. I'm not attracted by this, but I think we need to be much more sober minded about the transactions we enter in with going into the future. So,
without being too political here, Clinton, I think it's somewhat ironic and frustrating that the blockchain was created for decentralized organizations and communities and a tech to move us forward. And this CBDC, personal opinion, is a threat to that, because it takes that technology, it takes that ability, and effectively centralizes it and uses it to effectively not give you control over what you can do, which is absolutely frightening to me. I agree. Some people might be screaming at their screens right now saying, whoa, 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 there's loads of benefits. Absolutely. They can airdrop you aid. They can airdrop you all sorts of wonderful help when the time comes to it, especially, hopefully we don't have another worldwide mass lockdown, for example, where they could easily airdrop stuff. That's brilliant. But if they have the blockchain, if they know who owns that particular wallet, they know exactly what you're doing at all times, and everyone will. Everyone, not just the government.
That's true. That is very true. Well, hey, we can get this might be a topic to explore on some darker evening in the future. But I hope everyone's enjoyed this. Thank you so much, Jamie, for a really enlightening and interesting conversation, just doing this contrasting tax laws. And anybody who's looking for UK tax advice, particularly if you're crypto investors and you have whether you live in the UK or whether you have engagements with UK-based businesses, and you need tax advice, definitely reach out to the expert, reach out to Jamie Nuttall. Jamie, could you just tell us again, how can they reach you?
Yeah, a few ways. The website is the most prominent, so that's mynaccountants.co. The other ways you can reach us is through Twitter. We're quite prominent on Twitter. Look up Myna Accountants, or if you want to come to me directly, Crypto Tax JME. I'm on there being an absolute degen. I'm fully doxed, having a good time. Reach out to me. I'll answer all questions. And welcome everyone. What about you, Clinton? How can people reach you?
Well, they can reach me at cryptotaxaudit.com. And you can learn we do tax prep, we do gain calculation for the tax return. We also defend people in audits before the IRS through the audit process, appeals, even up to tax court. So we're the top company in the US actually doing that threefold aspect. So we really focus on defending people in audits. So if you're getting audited, if you got a complex tax problem, international tax problem, we understand US people are taxed in a very complicated way outside the US. So we are experts in that. So yes, go to cryptotaxaudit.com. You can schedule the call right there. So thank you very much for your time. Thank you, everyone. Please hit the like or subscribe button. And as always, make money, pay your taxes, and make more money. Thank you.
Thank you very much for listening to today's show, and I hope you enjoy it. Please give us comments. We would love to respond to any questions you give us. If you have tax questions that we can apply to, we will try to address it in future shows. Please hit like, subscribe, follow. Thank you. Have a great day.
The Clinton Donnelly Show, where we explore how taxation and regulations of cryptocurrencies affect your daily life as an investor. Clinton is one of the top experts in crypto taxation in the US. Clinton has a law degree in international financial regulation. He is an enrolled agent and certified as a cryptocurrency anti-financial crime specialist. This show is sponsored by cryptotaxaudit.com, the income tax experts for US crypto investors. Go to cryptotaxaudit.com to learn more and schedule a private tax consultation now. The opinions expressed in this show are not legal advice. Tax and regulations are complicated. Your situation is unique, so you should always consult a tax professional.